The purpose of Wealth Talk is to educate, inform, and hopefully entertain you on the subject of building your wealth. Wealth Builders recommends you should always take independent financial, tax, or legal advice before making any decisions around your finances.
Today's episode is brought to you by Wealth Builders Membership, a proven step-by-step process that helps you achieve financial security within 2 to 3 years. To find out more, head to wealthbuilders.co.uk/membership.
Hello and welcome to this episode of Wealth Talk, a place where you can learn how to build and protect and then ultimately, of course, transfer your wealth. And I'm joined today by somebody known to many of us. He's the SSAS director at Wealth Builders and a colleague of mine. It's Paul Brooks. So welcome, Paul.
Hey, Kevin. How are you?
I'm tickety-boo, thanks very much. And I know we both like to have a bit of a refresh and a recharge and get our batteries replenished, don't we? And I think we both had a little bit of a break. You in sunnier climes, me in colder climes. How was your trip?
It was great, thank you. Yes, lots of time with the family, which is great. I know you appreciate that too. It's always good to get away and spend time with your loved ones. So every time I get the opportunity to do that, it's well received for me. And a little bit blustery, I have to say, for the first week, but good, really nice.
Is that over in the Canaries? They're known for that, aren't they?
They are, but a bit more blustery than usual this time round. So, but it was fine. You know, there's always things to do there, and then it was good to just get the opportunity to relax and unwind a little bit.
Well, welcome to a bit of my bluster because I'm not happy.
Oh yeah, okay.
I'm not happy because the royal assent has been signed. The stamp of approval has been made. No longer a proposition, but a firm enshrinement into law, which is the pensions law under the Finance Act, which says the government now got a license to print money. And no, I don't mean it's the Bank of England or the Royal Mint, although we can talk about minted. The government now are able, from April 2027, to tax pensions on death. And I've never seen that before, so I'm going to bluster about that as I have done for many years. But I've just come back from a blustery country as well, actually. I was cruising the fjords and enjoying the serenity and the minus temperatures and came back looking a bit like a Viking. But for those who can see me sporting, something I don't normally wear. But anyway, I don't have the locks. So, just fixing that one in your thoughts if you're listening. But it's a big deal, right? So joking apart, the government are now taxing pensions from April 2027. And when I was cruising, I was thinking, because I always do, and you know that, when I come back, you go, right, what ideas has Kev got again?
Yeah, we all brace ourselves, Kevin.
Yeah, we do. So get braced for this one. The 7 C's, right, which is about retirement planning, given the new rules. And you can do the 7 C's of SSAS, I guess. But, and it came to me because when you're cruising, there was 2 C's, the North Sea, which everybody knows. And that's quite poignant for me because where my dad died, if you remember, on a North Sea oil rig. And so, that was poignant. But then I got blustered about a bit in the Norwegian Sea, was a bit choppy. So, in your nice cabin, and then go on the veranda with a sick bag in hand, just in case, but it was fine. But the sea legs definitely weren't there for a few hours. And when I was thinking about, wow, these 2 C's are remarkably different, I thought about the 7 C's, not sailing the 7 C's, but each letter meaning something that is relevant for our discussion today. So how about we give it a go? The first C, I'm going to talk generally, and if you can maybe bring your experience of SSAS and why SSAS can help in a way that perhaps traditional pensions can't, is control. Because whenever things change, you've got to be financially aware of the change so that you can choose and carefully react and make a decision. And that comes from clarity. That's not another C, but you get the point. That once you've got the clarity to understand, you can then make a decision about how you react and want to control that. Now, most people can't do anything about it because the law's just going to tax their money. But what can someone do with that's different in SSAS to be able to respond and make a decision about taking more control than a conventional pension, which is just be aware that if you die, the government have got the right to assess your money for tax? What are the control issues in SSAS then?
Yeah, the first, which is the thing that attracts most people to SSAS, is the ability to have control over how and where you invest your money before you get to a point where you're thinking about legacy. And let's not forget that a SSAS is just a type of pension, albeit a very sophisticated type of pension for entrepreneurs. So it's designed to help you build wealth in a very tax efficient way. And a SSAS uniquely puts you in the driving seat of your own pension in a way that others just can't. And it's very, very similar to being a director of your own limited company. You're at the top, you're making strategic decisions about how and where you want your business to go. Well, it's exactly the same with the SSAS. You make the decisions about how and where you want to invest your money and the kind of things that you want to do, along with any other trustees, family members, or business partners, or both potentially. But it ultimately means you're calling the shots, and you could dictate almost every element of how the SSAS runs, how it's going to be set up for future retirement, what's going to happen when you're no longer here.
That's a really interesting point, and one, that I've never thought of before. Obviously, different people listen to the podcast at different times, and some are regular listeners and some might be new. So SSAS being the small self-administered scheme is sort of a pension for business owners. So it's not for employees. However, there are entrepreneurs in the making, and you can create a limited company, within the space of a few months anyway, can't you? One of the distinctions you just made that, frankly, I've not thought about before, and I just want to check if you believe this to be true, that we know that most employees can't become wealthy because there's no leverage, there's no control, the structure's all created for them, and then they've got a risk of redundancy or AI or something interrupting the need for that work or their health indeed. Being in business puts you more in control of the processes, the structures, the outcomes, the ability to generate recurring income. Are you saying a conventional pension is like being an employee where the structure is already created for you and you're not in control, and a SSAS is like being in business because you create your own structures and you are in control? Is that a fair parallel?
I think it's absolutely a fair parallel. The ability to be flexible within a standard pension is almost non-existent because, as you just outlined there, all of the framework is created. The rules that govern what you can and can't do are in place. You don't get the ability to shape those. So, yeah, I think it's a great example of the entrepreneurial nature of a SSAS is a bit like the entrepreneurial nature of being a business owner and running a business rather than, the traditional employed route, for sure.
And I suppose that sort of leads to a thought, which is, you speak to most employees, they crave that dependency. And even though it might be an illusion for many, not all, because you can earn well and then save the proceeds and build wealth that way. But most people struggle with that. Whereas with the SSAS, because you've got that entrepreneurial desire already, you're already willing to get involved, you're already willing to make decisions. And to a certain degree, even if you don't want to invest in the stock market, which you can in the SSAS, we'll come on to that in a minute. But there are just more entrepreneurial things you can do, particularly around your own business and supporting that, or property, because you can buy property, commercial property, even residential property within certain more technical natures of SSAS. So, I see your point there. It doesn't suit everyone. It's not for everyone. The reason you're on is not to say, hey, guys, the SSAS is for everyone. It's to say, if you're an entrepreneurial person, if you're minded to want control, this might be something to take a look at, because it might just help you with your inheritance tax as well. And we'll definitely want to come on to that. Next C, Paul, is consolidation. Right? The reason why I thought, people should be thinking about consolidating more than ever before, because with inheritance tax coming, the responsibility for paying the inheritance tax on people's pensions when it's due falls on executors. And the executors need to know where their bloody pensions are. And given there's whatever it is now, 30 billion or more of pensions floating around in the sort of financial ether, as it were, unclaimed, yet there'd be inheritance tax due potentially on some of those pensions. So just putting your pension house in order, working out where things are, what to do to get them visible and then recorded for the next generation would be a good thing. And simplifying, instead of having a sort of a patchwork quilt of pensions accumulated in various places, having them in one place might just be a thing to consider. Yes, there are things you need to think about, like costs and benefits, but just generally, I think consolidation is a good thing to be thinking about. How does SSAS help with people consolidating? How does that actually work?
A SSAS can collect money from almost any type of existing pension. There are a few exceptions, and it's probably not worth getting into the detail of that now. But, if you've got a pension that is in some way connected to the stock market, goes up and down in value, and people accumulate pensions across their working life, don't they? Typically, I think the average number of pensions that we see when we're working with people is sort of 3 to 4, because over their working life of 15, 20, 25 years, they've accumulated different spells of employment and different pensions. The SSAS has got the ability to sort of collect all those up and bring them all into one place. So it's easy to, I suppose, think about that wealth all in one vehicle. And I'm sure we'll come on to this soon, but not just one person's consolidated pensions, but potentially, multiple people's consolidated pensions, which is where the compounding impact of that really kicks in as well. You're bringing together that capital all in one place, which means it's easier to manage, it's easier to invest again, and back to control again. You've got better control of your money. And when you've got better control of your money, you're going to get a better return.
And interestingly, although it's not another C that I thought of, is you can get more capital than you've actually got in a SSAS, can't you? Because if you have 2, 3, 4 people join their pensions together, and let's say it's 500,000 just for a number, then they can go to a bank and get another 250, can't they? So there's 50% addition can be borrowed, which means more spending power, more buying power, more control over the value of the asset, which if you've got a conventional pension and with an insurer and you say, well, go and see a bank and say, will you lend me money secured on this? You got no chance. So that's an interesting one. I didn't think about the capital piece, but it's a good one, Paul. Let's talk about costs or charges. I'm blustering, as you know, about inheritance tax, but I bluster equally on the subject of fees, because I think fees are like taxes. If you don't know what's happening, you just pay them willingly, lying down and letting the fees just get taken from you, removing compounding, removing capital, removing money from your pension without really having a sense of whether you can control those fees, yet you can. And even conventional pensions, you can look at the fees and charges and get transparency on that and consolidate into one plan, which would be just a lower cost to run. And that can save, at least on the building stage of a pension, controlling costs can mean more money in the pension in the end. How does the cost thing work as far as, let's talk about the running costs. We know there's a small amount of establishment cost of a SSAS, but from a running cost point of view, how does that give a SSAS owner or owners more control over their charges?
The great thing about a SSAS is the cost structure is not based on value, whereas most conventional pensions have a fee that is linked to a percentage of the underlying pot. Funds under management is, a phrase that's used a lot in the financial world, but basically means how much of your money have we got on our platform? It could be ISAs, it could be pensions, it could be collective accounts, doesn't matter. When you've got a traditional, and especially more, I guess, in the pension world and the sort of ISA world, you've got percentage of value is the charging basis. Ironically, the better your money does, the more you pay. Well, what's fantastic about a SSAS is it steps away from that model entirely and says, like a business, the cost of running the SSAS is not based on the revenue. It's not based on the profit. It's based on what work is being done. So you could have a large SSAS, £500,000, for example, instead of paying 1% or, £5,000 or 2%, when you think about, the fund cost and the platform costs and other costs that come in, you could be paying a sizable amount of cost each year. You could be running that same SSAS in a more entrepreneurial way, and it could be costing you £2,000 a year or £2,500 a year, or possibly even less, depending on what you're doing. And the great thing about it is you're charged for work that's done without any connection to the value of the investment or the value of the SSAS overall. So you step entirely away from a scenario where the more your money works, the more you pay.
So in this case, the more your money works, the more you keep.
Absolutely.
Okay, that's going to add to the value, and we want people to have great values, notwithstanding there needs to be a strategy to pay inheritance tax, but you don't want to avoid inheritance tax by having no money. I mean, that's counterintuitive, isn't it? All right, that was interesting, and I suppose it makes it easier to control, and the visibility of costs are there, because if it's one fee once a year, you can see what it is, and you don't have this opaque thing of how much am I paying again? I don't really know, because it's hidden somewhere in the small print on page 23.
There is one other big advantage of a SSAS from a cost perspective too, and probably not really recognised for most people. Because a SSAS is a type of company pension, you have to be a business owner to have a SSAS. All of the costs of running the SSAS are legitimate tax-deductible expenses for your business, which means if you're VAT registered, you eliminate or neutralise the VAT. And if, you've obviously then got the cost as a corporation tax deductible expense. So you're netting down, and the actual end result is you pay far less because you're getting tax relief. Well, in a SIP or a traditional personal pension or any other kind of pension, the fees can't be paid by the business. They're not a legitimate business expense. So you're paying the gross fee, whereas with the SSAS, you're paying, a netted down fee because you're saving on the tax.
Very good point. I think most people think if the business pays the contribution, the running cost of the pension, usually there'd be a SIP, wouldn't we? We see more SIPs than anything else. That the SIP running costs will be offsettable, but they're not. Interesting. I mean, that's quite a valuable benefit if you're talking about multiple members, multiple contributions over multiple years. That's massive.
Maybe we should have another C for compound.
Well, all these things will be, I suppose, blended together. But, the point of the C's was just for a bit of fun, to give us a framework to have a conversation. I'm sure more will come out in our dialogue. What about, you hinted at it earlier on, the fact that people can join together their pensions, husbands, wives, family, up generation, down generation, even side generation, provided it's appropriate and you've got the right plan, multiple people can join, because there's a maximum of 11 in a SSAS. So that's quite a big family, really. But how does the collaboration work? Because most conventional pensions, it's a pension for one. You're in a box for one. And therefore, you're paying charges in one box. I suppose if you've got 4 people joining a SSAS, they're removing 4 sets of different charges as well for one common charge, which is then visible to all. A bit like sort of amalgamating the pensions can bring an overall benefit for doing that. But how's the collaboration work in SSAS, both inside the SSAS and outside the SSAS, say?
Yeah, so when I'm kind of talking about collaboration, I'll talk about internal and external, as you just said there. So internal collaboration would be the ability to invite other people to bring their funds into the SSAS, and alongside yours, you've got a bigger investment war chest, if you like. And very commonly we see spouses or civil partners or life partners bring their pots together. But we also see couples with children, adult children. So to your point about down generation, you can actually start to build a family SSAS, which is, a genuine legacy asset because, the parents found the SSAS and then they bring their adult children in and start to build pension for their children. And that gives you a bigger pot, which you can then invest together as a family. So you're effectively consolidating, and we touched on that earlier, didn't we? Bringing together both existing pensions that are in various people's lives into one vehicle for ease of management, but also to give you more capital to invest with. You're then sharing the returns, amongst all of the family. So everyone's benefiting from the entrepreneurial activity at the SSAS.
And what about collaboration outside? I mean, in terms of what I touched on earlier with you can collaborate with a bank and borrow money, which you can't do in a personal pension or a workplace pension, for example. But how can you collaborate with others, even if they're not in the same scheme as you? So how does that work?
A SSAS can literally collaboratively purchase an asset, for example, with another business, with another person, or with another SSAS. So here's a good example. Imagine, you had a business partner, you had your own family, but you also had a business partner and they had their own family. You might not necessarily want to bring two family groups together in one SSAS. You could do, but you probably wouldn't want to. But if you each had your own SSAS as a family unit, you could, for example, buy the commercial premises for your business to operate from 50-50, let's say, between SSAS number one, family number one, and SSAS number two, which is family number two. So you pool together your resources, but without having to bring them together into the same vehicle. And when you've got a SSAS, it's really important that the trustees, your fellow trustees, your spouse, your partner, whoever it might be, are on the same page as you in terms of the investments that they want to make and the broad direction of travel. If you've got two individual SSASs collaborating, you can pick and choose the projects that you want to collaborate on, but you're not obligated to do everything together. So you can keep your family SSAS traveling in the direction you want it to travel, and you can bring it together with another SSAS or another business or something like that when you choose.
So not just collaborating with SSASs, but collaborate with your own company. So if you want to buy business premises, for example, that's really simple, isn't it? You could buy business premises and share it between you as the company and your SSAS as an extension of your family structures.
Absolutely. And we've had members do that. We've had, members who've collaboratively purchased things with SSAS, and, it works well because it gives you, I suppose, some diversification, which is another important factor. Lots of people are right to think about spreading their money and avoiding the all eggs in one basket scenario. And although, you could get into that in a number of ways, being able to potentially collaboratively buy a share of a building and a share of a rental income and then do the same again with another part of your pot gives you more diversification, which I think is always an important thing to have.
I suppose, new information for people, whether you've got a SSAS, whether you're interested in SSAS, doesn't matter. Just Paul's giving that extra dynamic. We've talked about control, talked about consolidation and the simplification, the need to control costs because costs are just like taxes, and we definitely need to start talking about inheritance tax as a tax in a minute. And then the creative point about being able to collaborate with yourself, with your company, with other companies, with other families, with other people, all of which brings, I suppose, that creativity, which would be another C if we were being cheeky now, wouldn't it? I have to rewrite this now, Paul. The 10 C's. But anyway, the big one. I want to talk about inheritance tax and the fact that unused pensions, and I'll just mention what unused pensions are, because not all pensions are affected by inheritance tax. There are some pensions which, by their nature, are not value-driven, but they're benefit-driven, where because it's a benefit, it doesn't count it as capital because inheritance tax is a tax on capital. not a tax on income. So if you've got a final salary pension because you work for the public sector or you're working for a big company, although they're pretty much all outdated now, they're pretty much all closed to new members, but some of our listeners will be members of final salary schemes. The income benefit you derive from those are not subject to inheritance tax, so you avoid that. And if you bought an annuity, where you've converted capital into an income stream, then the income stream isn't subject to inheritance tax. But most people don't have those kind of pensions anymore. They've got money in a pot. You can tell that because they get a statement or they've got an online platform and they can see it going up, going down, going sideways. Either way, that's natural. It's normal for that to happen. But if they have that volatility, the natural consequence of having a pension, you're building up a value, is because you don't know when you're going to go and you don't know exactly how much you're going to need, you need to build in a bit of margin for error. So you need a bigger pot than you're going to spend within the first few years. Otherwise, you're going to run out of money fast. So most people try and build the biggest pot possible. And I've fallen into that one. Tried to build the biggest pot possible, thinking that I can spend what I want, but whatever's left goes to my kids, or certainly my wife anyway. Inheritance tax-free to spouses, but not inheritance tax-free going to children. And that's a big deal if you built up a big pension or you're aspiring to build one. So within SSAS, though, there are some unique benefits. And I want you to talk about one, Paul, which I don't think anybody other than those who've listened to us will have heard before. And it's the C, which I'm going to call cascading, but you might want to mention the technical term that's used within SSAS that allows the money or value to flow from one generation to the next in a legal, well-organized, well-structured and well-documented way over time, not in one go. We're not going to get too technical, but what on earth is cascading? Why is it different in SSAS? And why is that a benefit?
Because a SSAS is a multi-person scheme, it brings with it a uniqueness that doesn't apply to any other pension, which is always for a single person. And that's, with multiple members, you can have multiple generations we talked about. Up generation, down generation, side generation. Let's use that same example from earlier, a couple and their adult children have a SSAS. Because all generations are in the same vehicle, you can use a really quite clever mechanism, which in the SSAS world is called earmarking. You've called it cascading, but earmarking is how it's known in the SSAS world. Effectively, what that means is you can choose within the SSAS which assets you want to be earmarked to which people. And that allows you to control where the flow of income or growth or returns goes on a member by member basis. If you've got to a point in your life, and let's use you as an example here, Kevin, maybe, you and your wife are in the SSAS and you've got to a point where you don't feel you need to grow the pot in your own name because you've got enough value there to give you the income you need.
Or in other assets, of course.
Or in other assets outside of the SSAS. Then you could choose to assign the assets with the lowest value to you and your wife and try and assign as much of the assets with the highest returns or the highest growth to your children. And if you do that every year alongside a continued effort to contribute money and grow the value of your children's pots, and they can therefore absorb more of the higher returning assets. And so over time, your asset base becomes more and more of the more low return assets, and your children's becomes more of the high returning assets. What you're effectively doing is deliberately stagnating the growth on your pot whilst artificially accelerating the growth on their pot. And so over time, and let's fast forward to a point where, both you and your wife are no longer here, and therefore that's when the inheritance tax calculation is done and the payment is due. You've actually left a smaller sum subject to inheritance tax than you would have otherwise left, because you've accelerated your children's pots and you've chosen to stagnate the growth on yours.
Yeah, and let's be clear about something. We're not stagnating the returns. We're still getting the same gross returns. So we're still focused on getting the highest possible return for our investments, but we're just being more flexible and more creative about how that's allocated and that gradual process over time. And that's unique, isn't it?
Absolutely. Because within the only other multi-person vehicles, pension vehicles, are large corporate schemes where, again, individual members are just clustered together. In the sense of, true collaboration, a SAS is the only vehicle that allows this, collaboration of people to come together and family members to come together and choose strategically for the long term how and where they want the growth to crystallize within the individual person in the scheme, and if you've got children, adult children that can join, and inheritance tax is a big problem for you and potentially only going to get bigger as time goes on and the value of your assets grows. Earmarking or cascading can be a really powerful way to mitigate the inheritance tax you would pay on your pensions.
Well, yeah, I mean, that's a really powerful point that I think is strangely not known by accountants, not known by lawyers, not known by your average financial advisors, yet they all have well-meaning intentions to help people keep and preserve and minimize inheritance tax. But it's an odd one that this just doesn't get the airing that it needs to get. And it reminds me, we talked earlier on about the control piece, that it feels like there's a difference between being an employee and being an entrepreneur. Is there a parallel here with something like a family investment company where you bring children in as shareholders and value owners in a company, but you're almost freezing the returns or stagnating, as you call it, the returns to you to provide greater returns to a next generation? There's some similarity there, do you think, or not?
No, for sure there is. It's a great parallel, actually, because, you are choosing to spill the lion's share of the returns over to the next generation before it becomes an inheritance tax problem. And in a nutshell, that's effectively part of, the principle of what a family investment company is doing, isn't it? It's either trying to freeze and lock in the value and then the rest of the new growth overspills to other shareholders who might be your children. It's exactly the same principle.
So I'm hearing that as we're discussing these things, there's an awful lot of purposeful intention going on here, not accidental results. And for some people, Paul, they get scared by that. Almost, these guys know what they're talking about. They've been doing it for years. How am I going to learn any of this? How am I going to implement any of this? It all sounds too complicated. And anyway, if it's that good, it can't be true. It can't be real. And the government are going to close it down because it's just a loophole. Continuity if we added another C. So how long has SAS been going? And why aren't the government going to close down any of this?
Well, they've been around since the 70s. Not too long ago, had their 50th anniversary. And people often think SAS is the new kid on the block and that SIPs have been around for a long time. And actually, the reality is, SIPs are the new kid on the block and SASs have been around for many, many decades now.
73 they came in. I remember I had hair then.
Yeah, okay. Back in the glory days. So, this is not a flash in the pan. These vehicles have been established, operating and enshrined in pension law for tens of years. It's unlikely they're going anywhere. And there's a lot of case law and precedent to back up the structure and the tax efficiency and some of the uniquenesses like the SAS, the ability to cascade and so on. So, the problem they're not so well known is because they step away from the vanilla funds under management, stock market only style that tends to be the default for most professions in the financial space. And most people understand pensions are by and large stock market focused, through employment or otherwise. It's really the job of all of us in the financial space to be thinking about educating anyone who's entrepreneurially minded and who's got a business that a SSAS exists, and it could be not a shoe-in, absolutely not, but it could be a genuinely viable option for their family wealth and to help them accelerate their business too. And we haven't really spoken too much about how it can do that, because the focus so far has been on thinking about, consolidation and cutting cost and collaborating and so on. But
yeah, we'll come on to that in a minute, but in fact, we'll do it next. But the thought I had as you were describing that is, if we talk about the legal obligation to have a workplace pension if you're an employee, and why these workplace pensions are on the stock market, is not because it's the best way to build a retirement. It's just the least risky for the employer, because they can't be held accountable for something that is just default. That's why they create default funds, where everything is done so that you are taking the risk, so they can't be sued. That's not a basis on how you build your wealth, that you take advice from somebody just avoiding being sued. The best person to deal with your wealth is you. So that's why I encourage people, even if they're not SSAS eligible, they think about how they could take more control than less control. But let's talk about the companies then, because if you're an employee, it's not relevant for you. But if you're a business owner, and we've recently just supported the biggest sort of community of business owners getting together in one room called BizX, or Business Excellence, sponsored and promoted by the good people at Action Coach. And often, and I know I've spoken on that stage with 2,000 or more business owners, and that's a lot of business owners. And this kind of gets through to people in those sorts of environments, but they don't know that a SSAS can actually help the company. And our personal pension can't help a company, because it's not designed to do anything but support you as an individual. So other than being a director and having control and managing costs and all that, what is a distinctive feature of SSAS that would help me as the owner of a limited company?
I think the standout feature, and the thing that when people understand it, they're hugely enthusiastic about it, is being able to do a company loan and actually lend some money from the SSAS to your limited company.
And that's my 6C. C for company loan. How does that work, and why is that a good thing?
It works very simply by you deciding that as the lender, you're going to lend some money to your business, the borrower, and you sit on both sides of that transaction. So unless you have a fallout with yourself at some point in those negotiations, you're able to lend yourself money from your own pension for legitimately any business purpose. No matter what your business does, it can borrow money from your SSAS. Now, there are some rules, chief among which is you've got to give some security, because the regulators of the pension world, need to make sure that you're not overexposing yourself to risk. You're lending money from your pension to your business. So there needs to be some security, which can come in a number of different forms. And we don't need to get into that right now. But the purpose of the money is whatever you can use it for to accelerate your business. And there is no exclusion. There is no type of limited company that can't borrow the money. So whether it's general trading, consultancy, manufacturing, property, it can all be done. If you're a business owner and you want to accelerate your business, find a new source of revenue, do something that's going to make you more profitable, and you need to borrow money, you need capital for that, why not look to your own pension? Borrow money from yourself rather than having to go to a traditional financial institution where you have to go through the ringer, and they may or may not lend money to you. And, they may or may not want to charge you a fee that's reasonable. And they may or may not want to charge you an interest rate that's reasonable, likely to not be. And your wealth, money's going out of your life and eating into your profits. Well, in this scenario, you could almost argue it's cost free, because although a SSAS has to charge some interest for the lending, you're effectively just paying money from your business straight into your SSAS. So it's going from one asset you own into another asset you own.
And what's the interest rate then?
Well, I mean, historically, it's been much lower because interest rates have been lower, and it is linked, broadly speaking, to the base rate, but it's 1 over base. Pretty cheap money still, even now in a period where interest rates are a little bit higher than they have been, say, in the last 5 years, or certainly over the last 12 or 18 months anyway.
So if you're a property business owner, let's just say, where traditionally if you wanted to borrow money, you would perhaps go to a bridging company, go through the process of the underwriting, go through the process of the fee charging, in entry fees, exit fees, plus the actual interest, and that money, all of that money flows out of your life. But here, all of the money is flowing back into your life in a virtuous circle where your own money is supporting you, supporting your business, supporting you, supporting your family. What's not to like? I'm struggling here.
Well, believe it or not, I know it sounds as if it's a bit too good to be true. It genuinely isn't. If you use that example, and it's a great one to use, bridging finance costs a fortune and is probably the single biggest line item on most property developers, list of costs. If you can avoid all the setup costs and the entry costs and the exit costs and the spurious valuations that have to be done periodically, and simply just pay a rate of interest that is much lower, you're saving potentially tens of thousands of pounds, depending on the size of the loan, each time you do that. When you then factor in that you're only paying 1 over base as an interest rate, but actually, if you want to, you could pay a higher rate, if you want to save tax, because the interest is tax deductible for your company. Just because you're borrowing money from your own SSAS, the interest is still a tax deductible expense. So if you were in a place where you wanted to save tax and that was a priority, you could charge a higher rate of interest if you wanted. It's up to you, but most developers choose to pay the lower rate of interest, save all the fees, keep more capital, keep more cash flow within the business to facilitate either other developments or to draw out money to fund their lifestyle. But the company loan, or as it's more formally known, the SSAS loan back, is a fantastically powerful tool to help property investors, property developers, and general business owners to accelerate their businesses in one way.
I wonder how many business owners who, for no reason other than COVID, got hammered, would have been grateful to know that the pension funds that they'd consigned into a box that says, do not disturb till I'm old, was always regarded separately and thought of completely as an independent source of capital, could have been brought to good use and helped those businesses to save them either struggling or to have them borrowing money that, ended up depleting their reserves. I mean, it seems the benefit you mentioned, the sort of virtuous spiral, felt a bit similar to business owners buying their own business premises, where they're paying rent to themselves, not to a third party. And every penny in rent they charge to the company is actually a tax-deductible expense. And then so the merry-go-round goes around, but for benefit. So it's nothing new. It's just maybe articulating it, if you're a business owner and hearing it, might be, I never even knew that was possible, the SSAS loan back, or my 60, which is company loan. We're going to hit the last one, Paul. I know we could keep going, but we'll do one more, and maybe you might squeeze an extra one if you want to. But the 7th one, which is important to me, not just the legacy planning for IHT, but what we haven't talked about specifically is the fact that, although you alluded to in the cascading, is you can bring children in as members. So they join the scheme. Now, I'm going to talk about what I think is a benefit from a legacy point of view, and maybe you could talk about it from an IHT viewpoint, that if you, in the end, almost every country, every culture in the world has got a recognition, an old adage, that money gets depleted within 3 generations. And it plays out remarkably in all economies, shirt sleeves to shirt sleeves, clogs to clogs, whatever. There's a language for it, and it plays out so regularly. And that's because at least one of the points is, so often there's no intergenerational wisdom. There's no discussion. There's no involvement. There's no transfer of stewardship. There's just an expectation that when mum and dad go, we're just going to have to sort it, pay the tax, and spend what's left. The point about SSAS for me is it gives the opportunity to bring children in. That doesn't mean kids, but from age 18, right? It's not, you've got to be an adult. But as age appropriate and as ready appropriate as your child is, because not all 18-year-olds are the same as other 18-year-olds. I know that. You can involve them in small ways to have discussions and meetings and projects and investments and so on that starts to involve them in a process of understanding that they're part of it. They're not apart from it. You want to comment on that and how that might help the intentional way that stewardship and pensions can work together?
It's a really fantastic way to sort of bridge the gap between full involvement and a legal obligation and letting them dip their toe in the water, especially even if perhaps they're 18 but they're not quite ready, or they're not even quite 18 but they can start to understand and grasp, even at a basic level, what the family wealth plan looks like. And we do a lot of that work with people, don't we, Kevin? At a higher level, when we're helping them think about that transition and legacy, is to build a framework to involve the children at the right time. Having your children understand what you're doing and why you're doing it is such a powerful thing, and it piques their interest and gets them ready for the stage where at some point in the not too distant future they can actually become part of the scheme, sit alongside you as a trustee. The whole collaborative nature of a SSAS is so geared up to supporting multiple generations of the same family to build wealth and become the best custodians in the future. And it's by default. You don't have to change anything. You don't have to go through any complexity. A SSAS by default is a ready-made perpetual legacy vehicle. When you start the education is down to you as a family. But I think you probably echo the view that the sooner the better, really. The sooner you can start having those conversations, helping them see and understand what you're doing and why you're doing it and what the long-term benefit is, the stronger the wealth plan will be. And you break the potential 3-generation cycle, hopefully, or the start of it at least.
That's certainly my intention, is to help the families that we serve. And we've talked on recent podcasts, Paul, about the Family Wealth Fortress. And SSAS is an integral part of that, isn't it? Because it's such a teacher. It's such an involver, and it's such a brilliant way to kind of bridge that gap, because pensions are just one piece of the jigsaw puzzle of some families' assets, but it's the easiest one to sort of get people involved, because even kids who, all my kids are involved in jobs and so on, and they've all got pensions, so they have to have one. So it's part of their natural dialogue anyway, but it perhaps brings a level of interest to it. That's been a really interesting round robin of control, consolidation, costs, collaboration, cascading, company loan, and children. I think that's, been useful to give a framework. And I think anybody who's got a family and a pension needs to do something, whether you're interested in SSAS or not. And thank you for sharing, Paul, the joys of SSAS, so to speak. For those who aren't eligible, just stop thinking, please, about getting more involved, taking more control, being a bit more aware, check your charges, find your lost pensions, make it easy for the next generation, and maybe have some dialogue with your kids about what you're doing, because in the end, somebody's got to teach them. And if you don't teach them, who's going to teach them? Mr. Trump? Mr. Musk? I don't know. I think I'd much rather be in control. Any final words from you, sir?
If you're interested to learn more about SSAS, we've got lots of free resources, dip a toe in the water, learn a little bit more. ask a question, reach out and our team will, furnish you with as much or as little information as you want to start to understand a bit more about it. If this is the first time you've heard about it, or if something we've talked about today has piqued your interest and made you sit up and pay attention, perhaps now is the time to take an action and make, this next 30 days, a SaaS exploration action for yourself.
Yeah, it's a great point, Paul, that, there's a danger, isn't there, when you and I, as experts, talk and we talk confidently. It sounds easy, but it also sounds complex because we're bringing words in that people haven't really heard before. And I think the job that you and I have got is to create curiosity. And that curiosity just means go find out. And we've got books and podcasts and videos. So whatever your learning style is, just get something, right? And we've even going to create this as a infographic as well, if you just want to see everything on one page, to make it easy for you. And the way to do that is drop us an email, hello@wealthbuilders.co.uk, and we'll, as we'll say, furnish you with whatever you need. And if, by the way, you've already heard from us and you've done a SaaS already, just find out a little bit more about how the cascading works. Think more about when are you going to involve your next generation. And we'll do some clinics on the inside of Wealth Builders to talk more about that in coming weeks, because the runway is only less than a year away now. That's not very long to be aware of the fact that in April 2027, it's here. So you need to put it on your radar. Paul, thanks for joining us today on the podcast. I really genuinely appreciate you taking the time out. I'll look forward to, I'm not sure who's the next guest presenter, but we'll have another episode of Wealth Talk for you very soon. Until then, everyone, see ya.
We hope you enjoyed today's episode. Don't forget that we are constantly updating our resources inside the Wealth Builders membership site to help you create, build, and protect your wealth. Head over to wealthbuilders.co.uk/membership right now for free access. That's wealthbuilders.co.uk/membership.